Bloomberg Audio Studios. Podcasts, radio, news.
This is the closing bell on the Stock Movers Report. The companies making moves at the close of U.S. trading with Carol Massar, Tim Stenovec, Romaine Bostick, and Katie Greifeld.
United Airlines crossing the wire right now. Let's get right to it here. We had gotten a little bit of a sense here of how the airlines were doing after the results last week by Delta. United saying that in the fourth quarter, CapEx at $1.89 billion. EPS looks like a beat at $3.10 a share. The street was looking for $2.92 a share. Operating revenue, $15.4 billion, relatively in line with estimates. The shares up fractionally here in the after hours trade.
Meanwhile, let's get to Netflix here, crossing the terminal. And this is the red headline. When it comes to 2026 revenue, the outlook there, $50.7 billion to $51.7 billion. The estimate had been for $50.96 billion. Meanwhile, you take a look in terms of what we saw when it comes to the fourth quarter. You saw fourth quarter revenue come in above expectations, coming in just over $12 billion. The estimate had been for $11.97 billion. And then their free cash flow in the fourth quarter coming in at $1.87 billion versus $1.46 billion. So when it comes to the look back, fourth quarter EPS also coming in above expectations. It looks like we beat on a lot of metrics, but then again, you go to the 2026 numbers, ad revenue seen about doubling versus 2025, and their second half 2026 operating income growth to exceed the first half, but still you can see that investors finding something to not really like in this report. Netflix shares currently down about 1% after hours.
Yeah, perhaps as a cautious forecast. It cited higher program spending, the cost of closing its deal with Warner Brothers Discovery. So certainly a lot hinges on that if that deal goes through. The company does plan to increase spending on films and TV shows by 10% this year. It forecasts earnings of 76 cents a share. Wall Street wanted to see 82 cents a share. We'll see if that Warner Brothers Discovery, I'm sure that's going to be the question that analysts are looking for, especially now as the company has changed what its offer looks like, going all cash at this point.
All right, so Netflix still down about 2% here in the aftermarket. We're certain that will come up on the call with analysts. In the meantime, let's go back to United Airlines, because certainly a great read on the consumer. We did see United actually beating Wall Street estimates for the fourth quarter. It anticipates a strong 2026, driven by strong demand from high-spending domestic passengers and those international travelers. So they're looking at full-year earnings per share for 2026 to be in a range of $12 to $14 a share, compared to the $13.06 that analysts are predicting. Keep in mind, their results driven by demand, again, for those premium seating and overseas travel. Premium revenue up 9%, loyalty revenue up 10% in the fourth quarter, and that stock popping up now, up about 2.25%, now up about 1.5% here, guys, in the aftermarket.
All right, I do want to go back to Netflix here. We need to dive a little bit deeper into these numbers, because this isn't just a revenue and growth story. It's a cost story as well, with the company saying that it will boost by about 10% its spending on programs. But it released a supplementary statement that's on its website talking about what's actually driving that. And a big driver of this, no surprise, is actually non-English language titles, saying they accounted for over a third of the viewing that we saw in the most recent quarter. They specifically cite Korean, Spanish, and Japanese shows. They also talk about this big push into other markets in Europe, including Denmark and Norway, speaking of which, but also the idea of an expansion of some of their comedies, an expansion of some of their live events, all of which, we should point out, will cost them a lot more money. And the question is, are investors going to be comfortable with that spend, particularly potentially on top of another $82 billion or so that it might have to pay up if it does win the rights for Warner Brothers?
Well,
yeah, go ahead, Katie.
I was just going to say, it's interesting. You can also see in the commentary, Netflix plans to pause its share buybacks to accumulate the cash it needs to help fund that pending Warner Brothers acquisition. They amended that bid to be all cash, as a result, pausing buybacks, typically not exactly popular among shareholders.
Yeah, and we should point out that this all cash bid, which we keep talking about, a lot of that, more than half of that, is going to be actual debt. So you're not only talking about a depletion of cash on the balance sheet, you're adding debt to the balance sheet. And then, of course, there's this general idea here as well of all the other spending that they have to do.
Yeah, continuing to look through the supplemental materials that Netflix released in these earnings, shares down after hours by about 3.3%. The company said Netflix originals that thrilled audiences everywhere. Of course, K-pop Demon Hunters, Stranger Things, Wednesday, but then also an entire section about non-English language titles that remained widely watched. The Great Flood in South Korea, Love Untangled, Bon Appetit, Your Majesty. In Japan, people like The Last Samurai Standing, Season 1. There are numbers in here, too. That title, 21 million. For example, Spain had several popular shows, Brazil. Netflix making the point and saying this, hey, we've got something for everyone out there, no matter where you live, no matter what you like.
I want to go back to what, Romaine was talking about, the spend. And certainly we talk about these guys all the time, all of the streamers, in terms of the spend in order to get content so people are signing up and staying on their platforms. Having said that, the company, again, going back to the year forecast, seeing operating margin 31.5%. The estimate was above that at 32.4%. Sees free cash flow about $11 billion. The estimate was almost $12 billion. But I want to go back to the commentary. The company saying it sees, quote, plenty of room to increase margins. Company intends to grow operating margin each year. So, right, we talk about the spend, but we also talk about, what that does basically to the profitability, Romaine, of that company.
And we talk about the margins for the most recent quarter coming in at about 24.5%. That's the operating margin, we should point out. And that is up from about 22% year over year.
The Stock Movers Report from Bloomberg Radio. Check back with us throughout the day for the latest roundup of companies making news on Wall Street. And for the latest market-moving headlines, listen to Bloomberg Radio live. Catch us on YouTube, Bloomberg.com, and on Apple CarPlay and Android Auto with the Bloomberg Business app.